Hi. I know this is the second time I've worn this sweater to do a webcast. I promise you this will be the last time you see this sweater. But I wanted to spend this particular webcast talking about how to estimate the risk-free rate. Should be pretty simple, right? In fact, when I was taught finance, this was a given. You were told the risk-free rate is X percent. Use the 10-year T-bond rate and move on. Well, life isn't that simple anymore. So what I'd like to do is lay the foundations for what a risk-free rate is and then take you through the process of how best to estimate it. So here's the basic theme for a risk-free rate. If you ask me to define a risk-free rate, a risk-free investment is one where I know exactly what I'm going to make with certainty. Think about it, with certainty. So for something to be risk-free, it's got to meet two conditions. First, the entity issuing the security has to have no default risk, not a single piece, not even an iota. And the second is the cash flows can have no reinvestment risk. Put differently, if you have a 5-year cash flow, a 3-month T-bill is not risk-free, even if the US Treasury is default-free, because at the end of the 3 months, you got to reinvest again and reinvest yet again. So you have to have no reinvestment risk. So as a purist, you could actually argue that the right risk-free rate to use would have to reflect the time horizon of your cash flows, that you'd have a different risk-free rate for each cash flow. There's an approximation that I think works pretty well in corporate finance and valuation. Since much of what we do is long-term, I would argue that if you can find a default-free long-term rate, 10 years for instance, you got a pretty good approximation of the risk-free rate. So that becomes the challenge you face in any given currency. What is the closest thing I can find to a 10-year default-free rate in this currency? So that's the process for the exercise. Let's start simple. Every day when you open up the Financial Times, if you look at the inside bond pages, there's a benchmark government bond page. And I pulled this off a couple of days ago. And what you've seen are my highlighted countries, which are all AAA rated. The only exception is Japan, but in a moment I'm going to explain why Japan is, I'm still treating it as if it were AAA rated. And here's why I've isolated these countries. In these countries, if you assume the ratings agencies know what they're doing, and I know that's a pretty dangerous assumption, then the assumption can be made in these countries that there's no default risk. So if you take Australia and you make that assumption, then you can find a long-term bond. In this case, I've isolated all the 10-year bonds that are as close to 10 years as I can find. And the rate, the yield on a 10-year bond, and I've highlighted that number as well, is 3.55%. I do the same thing for Canada and Denmark. For the euro, actually, if you look, there are probably about 10 different governments on this list which issue euro-denominated bonds. I've picked the German 10-year euro bond. Not because it's German, but because it's the lowest of the rates. The argument being that all of the other 10-year euro bond rates are higher because there's default risk. So if you ask me for risk-free rates in a bunch of currencies, I have about 10 different currencies here where I have a starting point. So the US dollar risk-free rate is 2.01%. The British pound is 2.18%. The Japanese yen is 0.75%. And as I said, Japan has been one of those countries where there are some ratings agencies that have given it a less than AAA rating and others still give the AAA rating. So I'm going to leave it in the AAA category for the moment. So this is the easy case. If you have a AAA rated country issuing bonds in that currency, you can use that rate perhaps as your risk-free rate. Okay? But what happens if there is no default-free entity? As is often the case in many emerging markets, how do you come up with a risk-free rate? Let's set up the mathematics. When you look at a government bond rate in one of these countries, what you get in that rate are two components, a risk-free rate in that currency and a default spread that gets added on. So the mathematical exercise is a pretty simple one. If you can estimate how much the default spread is, then you can take it out of the government bond rate and you have a risk-free rate. So this entire exercise becomes how best can you estimate that default spread on a government bond. So I'm going to take you through an exercise in which I tried to do this. It's very recent. It's February 20th of 2013 that I tried this. The first step in this process, and let's say I want to get a risk-free rate in nominal reais. You can do it in any of the currencies below, but I'm going to use the real to illustrate my process. So I want a risk-free rate in nominal reais. First step is finding a long-term government bond rate denominated in that currency. See that website listed up there? It's a great website. I don't know how accurate it is, but I'm not going to look a gift horse in the mouth. It actually gives me 10-year rates in the local currency for a bunch of countries that I otherwise would have had a tough time getting rates for. So you've seen me highlight Brazil. And if you look across and you look at the rate, the most recent rate for Brazil is 9.71%. So a 10-year nominal real denominated Brazilian bond on February 20th of 2013 had an interest rate of 9.71%. My task is laid out for me. I have to figure out how much of that 9.71% is default risk and take it out of the process. I'm going to take you through 3 ways, all of which I can use for Brazil and show you the different numbers I got. Here's the first. If your emerging market, the country you're interested in, issues dollar or euro denominated bonds, you can get a default spread from those bonds. So again, I'll use Brazil as my example to illustrate this process again. This again is a table that shows up in the FT pretty much every day. It's a table that lists high yield and emerging market bonds. And if you look at the emerging US dollar bonds, you see Brazil listed twice. There's a 2015 bond up front and a 2020 below. I've gone with the 2020 bond because I want a long-term bond. And if you look right all the way across that line, in the very last column, you see a spread versus the US T-bond of roughly the same duration. So the 7-year or roughly whatever the 2020 bond works out to, Brazilian bond, has and this is a dollar denominated bond, is an interest rate 0.74% higher than the US bond. Why is it higher? Because the borrowers, people buying this bond at least, see more default risk in Brazil than they do in the US. And the spread they've attached is 0.74%. Now this is the default spread for Brazilian dollar denominated bonds. I want a default spread for Brazilian local currency bonds, but here I cheated. If you look at the sovereign ratings for Brazil, and I'll show you how to get them in a minute, the sovereign rating for Brazil is Baa2 for both its local currency and its foreign currency bonds. Again, assuming ratings agencies know what they're doing. I can then make the assumption that the default spread is 0.74% for the dollar denominated bond. It's got to be roughly that same spread for the euro denominated bond. Just as an aside, if you look at the emerging euro bonds, I think FT screws up on this because it computes a spread on those bonds relative to the USD bond. And you know what they should be computing it against, right? These are euro-denominated bonds. If you want a spread, you should be comparing it to a euro risk-free rate, not a US risk-free rate. So if I were doing this table, at least for the emerging euro bonds, the spread should be against a German 10-year euro bond. But that's neither here nor there. It's a different way of getting the spread as well. So this is the first approach, is getting the default spread from a dollar or euro-denominated bond. This will tend to work for a lot of Latin American countries because they tend to have dollar-denominated bonds, and for some of the East European countries, which often have euro-denominated bonds. But let me give you a second approach if the first one doesn't work. The second approach is to go to the CDS market, the credit default swap market. This market is basically an insurance market. Okay, so if you look down the first column, you find Brazil. You go across and it says spread 158.71. You're saying, what the heck is that? First thing to remember is this is a fixed income market, so everything is stated in basis points. So that's 1.59%. Saying, what does that tell me? If you believe this market, that is what will cost you to buy insurance against Brazilian default risk. So if you buy a Brazilian dollar denominated bond with an interest rate of 4%, and you wanted to insure against default risk, you could go to the CDS market and pay 1.59 of that 4%, and you would end up with something risk-free. So it's in a sense a measure of the default spread. The CDS market has its own little quirks, and one of the quirks is that there's credit, counterparty risk, and the spreads are never zero, even for countries like Switzerland where you know there's no default risk. So one way you can correct this spread if you're not comfortable with using the entire spread is you can take the default spread for maybe a Switzerland, US, and Germany and subtract it from the 1.59%. So when I tried that on February 20th of 2013, for instance, the average spread across those countries was about 0.5%. Subtracting that would give you an adjusted CDS spread of 1.09%, but that's a little fancy. You can stay with the 1.59% as a default spread and not make that correction if that's too complicated. So you can use a government bond denominated in dollars, you can use a CDS spread. You're saying, but what if my country does not have dollar-denominated bonds, doesn't have a CDS spread? There is a third choice. If your country has a sovereign rating, Moody's, S&P, Fitch, all rate countries, you can use the rating to come up with the default spread. Let me explain this. I went to the Moody's website, I clicked on sovereign ratings, and I saw you'll see the page pop up. In fact, if you look to the right, you'll see me highlight the export. If you click on that, it'll actually download an Excel spreadsheet. It's great. It's free and it's great. Can't get any better than that. So I looked down and I found Brazil. And remember what I said, there are 2 ratings for every country. There's a foreign currency rating and a local currency rating. If you look down the column, there's the foreign currency rating for Brazil is Baa2, but the rating I'm interested in is the local currency rating, Baa2. So let's say I did not have the first two approaches, that all I had for Brazil was a sovereign rating of Baa2. If I could somehow convert that rating into a default spread, I could use it, right? I have a lookup table on my website that allows me to do this. Basically, you tell me the rating for a country, in this case Baa2. I'll tell you what the typical default spread is. Sounds like magic, but here's all I do. I go find CDSs and dollar-denominated bonds with each rating, and I look at the spreads and I average those spreads out. So as an example, again, if you take Baa2 rated countries, there are about 11 Baa2 rated countries in the world. 9 of them have CDS spreads and dollar-denominated bonds. I actually take the average spread across those nine countries for which I can get the numbers. That's how I built up the table, and it's a godsend, and you cannot find a CDS or a dollar-denominated bond. So in this case, with Brazil, I'm getting a 1.75% default spread based on its rating. So once you get the default spread, here's the last step. To get to a risk-free rate then, I take that nominal real government bond rate, 9.71% that I got, and I subtract out the default spread. So if I use the first approach, which is the dollar-denominated bond, the spread is 0.74%. Subtracting it from 9.71% gives me a nominal real risk-free rate of 8.97%. If I use the CDS spread of 1.59%, I get a lower risk-free rate, 8.12%, because I'm subtracting 1.59 from the 9.71%. If I use the rating, it should be a Baa2 rating. The default spread is 1.75%. The spread I'm subtracted out from my nominal real risk-free rate gives me a 7.43% risk-free rate. You think, which one should I use? It's going to sound strange. Pick one and stay consistent. And it's not going to matter that much. You're saying, how can it not matter? I'm getting different numbers. This default spread is going to come back into your analysis later. And if you use a low default spread here, it'll help you. It'll hurt you in terms of having a higher risk-free rate. But it might change the risk premium used for this country. So it's okay. Just pick one or use an average, but be consistent about what uses a default spread. So that's the basic approach. Last note, sometimes you'll hit desperation time. Why? Because you might find that your government has no long-term, has no dollar-denominated bonds and no CDS spreads, but as long as there's a sovereign rating, you can still get away with it. India is a good example. It does not have dollar-denominated bonds or euro-denominated bonds. It does not have a CDS spread, but it does have a sovereign rating. You can use the third approach. And once in a while, you will run into a government which has no dollar-denominated bonds, no CDS spread, no sovereign ratings. You're in the soup now, right? Well, a couple of choices. One is you can cheat. There's an outfit called PRS, which is which actually gives country risk scores. So if you could find another, so let's say your country has none of the variables we use to get the default spread, but has a PRS score of 75. If you can find another country with roughly that same PRS score, which has a sovereign rating, maybe you can use the country risk premium for that country. I know it's stretching, but if you really want a risk-free rate, that might be your only choice. I actually prefer a second alternative. If I'm having this much trouble getting a risk-free rate, I don't want to have anything to do with this currency. I'm going to switch currencies and do my analysis in a different currency. In fact, this used to be my ploy in Brazil until about 6 years ago when you had a tough time getting long-term dollar-denominated Brazilian bonds. I used to value Brazilian companies in US dollars. And if you do it consistently, it shouldn't really matter which currency you do a valuation or corporate finance analysis in. So in summary, get a risk-free rate nailed down because things are going to get very hairy from this point on. And without a risk-free rate, everything else becomes kind of an afterthought. That's about it. Thank you very much for listening in. I'll see you in a couple of days.